Naveen Chandramohan, who is the founder and fund manager at IT US Capital, now joins in to discuss his views on the market. Naveen, hi, welcome to the show. Well, this entire week has been marked by volatility due to geopolitical tensions. Any kind of portfolio changes that you made and for your clients and which you would be recommending?
Thanks a lot for having me on the show. I think from our perspective, right, portfolio changes are not a function of the price, but more so a function of earnings growth. And that's where we actually monitor cash flow growth of the companies that are actually reporting. So if you look at the December quarter earnings of the portfolio companies that we own, they have compounded at almost 21% on a year-on-year basis. And in fact, on a 2-year CAGR basis, which is slightly more relevant for us because we're talking about a low base, the compounding is at 21%, even on a 2-year basis. So effectively, you're talking about supply chain disruptions, you're talking about Fed increased rates, you're talking about Ukraine, Russia. Those are things that are not under your control. What's under your control is, do these companies have pricing power? And do these companies have the ability to actually gain market share and translate those earnings into cash flows? And as long as that's happening, I think we are in a good spot. So that's how we think about portfolio construction and risk management.
Okay. Naveen, hi. Good afternoon. I was going through your fact sheet, and you have the largest sectoral exposure to the IT services space, about 14% or so. And within that, one of your top 10 holdings is Infosys, with a 6% exposure. Just trying to understand what the texture could look like, because many of these stocks are down 15-20% this year. There is some caution as far as, higher attrition rates, some margin pressures as well. Is this the best time to be buying into these names, or do you think that they could move to the back burner for a while?
Sure. So I wouldn't, so specifically with regard to Infosys, we've owned it for a while now. It's almost been 3 years. And we continue to own it primarily because of what is actually happening globally and specifically within Infosys, right? If you look at the landscape, no longer is spending on IT, it's a necessity today, right? That's what a business needs for it to run business. And how do you actually verify it from a facts perspective? Look at the number of billion-dollar deals Infosys is winning. It's the first time in history. And when a company moves from, let's say, a $500 million deal flow to a billion-dollar deal flow, it doesn't actually mean revert back to $500 million. That's a transition a company is actually making in its history, right? So companies are spending, and Infosys is not just a services company anymore, right? Infosys has evolved from a services to a product company. Unfortunately, we keep calling it still a services company, but it's still a product company on top as well. So from my view, I think unless and until something fundamentally changes in the landscape, these are companies that we would want to be owning for the next 3 to 5 years from a cycle perspective, rather than react to quarterly attrition or quarterly changes in terms of employees actually making, demanding higher salaries. So we wouldn't want to be reacting to short-term trends, but look at it from a more structural perspective. So yes, we continue to be optimistic on the stock. Buying it at these levels is a different decision. I think that's something that I wouldn't want to comment on today. But if you're talking about from a fundamental perspective, yes, we continue to hold on to it, and our view doesn't change.
Okay. One of the interesting holdings that you have is Alembic Pharma, Naveen, because that particular company has had an absolutely tough 2-3 quarters. US pricing pressure, margin pressure, and the stock has corrected quite significantly as well. It was at over 1,000 odd rupees at a comfortable level, and now it's at just above 700. No definitive calls that you've taken within this entire space because of the US pricing pressure as well as other headwinds that they might be facing?
Absolutely. I think it's a very valid concern that you've raised, and we've had this concern for a while now. And the way we've managed the risk on a company like Alembic Pharma has been trimming down the position significantly. I think I would say 3 years back, that position would have been closer to 5-6%. Today, it's sub 1.5%. So I think we don't want exposures in the pharma bucket, especially in companies which have a significant US portfolio, because these are more cyclical in nature. Most of our pharma exposures are in companies either which have a domestic manufacturing operations or they have a predominant portion of their revenue coming from the domestic Indian business, where it's more of the branded generics that we're talking about. So I totally echo the theme, and that's how we've managed this position down as well.
There are many new themes that are coming up, right, Naveen, whether it is renewable energy, the green hydrogen policy, the electric vehicle theme. There's lots happening in that space and new technology as well. Can you identify for us 2 or 3 pockets of opportunity for retail investors here?
So the way I think about portfolio construction is more of bottom-up rather than top-down. But as a result of bottom-up construction, you obviously have exposure to certain themes, right? So gun pointed to my head if I'm going to say that I have to talk about 2 to 3 themes. Obviously, the first theme that we spoke about is tech platforms or IT services, no matter how you put it. I think this is theme, though you have volatility, this is something that we would want to own for the next 3 to 5 years. Second is what I call B2B non-lending financials, right? So for example, this could be exchanges, this could be service providers to the mutual fund industry, these could be asset management companies. I think as the financialization in India takes shape, and I think this is structural and here to stay, we continue to be optimistic this particular space. Third is what I would call B2B manufacturing predominantly, right? I mean, India has continued to be a manufacturing hub, but we've always come second to, in terms of calling second to China. And considering what COVID has done to supply chain as well as global companies looking at diversification, I think this is a theme here to stay as well. So B2B manufacturing with companies which have cash flows generation ability, that's a theme that again interests us. These are themes that we would like to play over the next 3 to 5 years.
Okay,